Good morning, everyone. Tim Nyland here. Today is December 2nd, 2020. Over the last couple weeks, we took a look at issues related to the value rotation, and we explored everything from what was going on with home builders to where we were in the actual cyclical cycle relative to the economy. And this week, we're going to shift gears a little bit and focus on some hypergrowth and talk about a name that I've really never talked about yet on a webinar, and it's definitely due for some coverage. So we're going to talk about Tesla, and we're going to talk about its entry into the S&P 500 index, and we're going to talk about the proper way to analyze hypergrowth stocks. So let's go ahead and get started. So Tesla being added to the S&P 500 on December 18th, it's been determined that it's going to happen all at once, which is, in my opinion, a great thing. Just get it over with. Current market cap is roughly $550 billion. It's important to understand how S&P does their index weightings. They are float adjusted, and Elon Musk owns 20% of the company. So when you look at the float adjusted weight, it's basically 80% or about 437 billion, and this is as of like yesterday. So keep in mind that you've got 17% of the total value of the S&P 500 is more or less tied to passive index investments, right? So that equates to about 72 billion, right? So to buy 72 billion, you got to sell 72 billion. And so this is definitely going to be the largest rebalance that S&P has ever been through with the S&P 500. The largest rebalance outside of what we're facing here on December 18th was back in September of 2018, and that was only 51 billion. So this is almost 50% larger. The interesting thing is that they've talked about volatility in the media and the press, but they really haven't identified which names are going to be most likely to suffer the most volatility. And if you do the math, it's actually going to be the smaller cap names in the S&P 500 that are going to need to be sold off the most to bring Tesla in. So everything basically below Facebook. The real issue we're going to explore is this bottom line on this particular slide. And keep in mind, this slide deck is available to anyone who requests it. Just shoot us an email, shoot me an email. We'll get to the email addresses here at the end of the webinar. But media outlets and asset managers alike on CNBC everywhere, a lot of people complaining, saying that passive index investors are going to get the short end of the stick. I've even heard it get called even uglier names. That I won't repeat, but that everyone's basically being forced to buy Tesla at all-time highs. And I want to talk to everybody at what the buzz is really about, right? And it's not necessarily, that Tesla is going to have to be bought at all-time highs here. It is at all-time highs, but I'm here to tell you that we haven't seen the highs yet with Tesla. So we can relax, right? So, but it's important to take a look at what the root of this fear is. And you can see it in this particular chart that I have on the screen. So Tesla's meteoric rise, what I call it meteoric rise to number 6 in market cap behind Facebook in the S&P 500. This has more or less taken place since March of this year. When you compare this to the performance of the earnings certain portfolio tilt stocks since 2012, and I picked 2012 because this is when I really started, paying attention to the companies that were really moving the S&P 500 in terms of performance. So these are some of your big winners, and take a look at Tesla, the standout. Okay, so what's really got everybody in a panic is everybody thinks that, what goes up must come back down. And I'm saying, not so fast, right? So in this particular case with regard to Tesla, it's definitely not true. I don't think we really need to worry about that. Are we looking at some potential volatility after the December 18th edition? Are we going to have some profit takers? Absolutely. Keep in mind, I do not own Tesla personally, but I do want to explore this with you. When we're looking at hyper growth companies, specifically the ones that are capital intensive like Tesla. Everyone thinks that Tesla is expensive because if you look at a PE ratio of Tesla relative to, say, an Apple that everybody's now saying is expensive, trading at 29 times, Tesla is trading at basically a forward PE multiple of 225 times earnings. And you'll see I have a big red X through the screen. There's a reason you can't use PEF12M, right? This is a hyper-growth company, a ton of investment, and we've got some charges that have actually hit the income statement that don't necessarily belong there when we're analyzing hyper-growth stocks. And if you try to adjust the PEF12M to account for forecast growth, it'll actually get you a lot closer, but it's still not the best measure to evaluate these capital-intensive hyper-growth companies. And you can see that if you look at an F12M PEG ratio, you can see that Tesla is, roughly 2.5x Apple here. But that's still not the best way to analyze a company like Tesla. And the reason for that is that when you look at these capital-intensive names like Tesla, especially at this phase in their development and their life cycle, it's not uncommon to see depreciation and amortization. Again, these are non-cash expenses that reside on the income statement, and they basically represent the cost of capital assets that are present on the balance sheet, and then they get expensed over time. But I want everybody to see in the Zacks research system here, I just put an income statement up, and I set it to common size, put everything as a percent of revenues. You can do this in advisor tools as well. And you can see that this non-cash charge actually makes up 10 to 15% of revenues. And when you're talking about margins for Tesla, net margins specifically, clocking in at like 1.97, this can make a huge difference in terms of trying to ascertain valuations. And so the preferred metric that I like to use is looking at total firm value, right? So it takes into account all of that capital intensiveness and everything that it took to basically get Tesla where it's at. And we look at profitability relative, or I should say prior to taxes, depreciation, and amortization, right? So this would be otherwise known as enterprise value to EBITDA. And I prefer the forward 12-month flavor of this rather than looking at trailing, because the forward 12-month actually gives us a 12-month forward forecast. And the real key here is to understand is that Apple and Tesla were equally valued just back in March of this year. And you can see that Tesla has just gone more or less parabolic. And keep in mind, too, that EV to EBITDA is not adjusted for Elon Musk's stock-based compensation. And, there's probably 50% of portfolio managers would argue this should be excluded, right? It's another, more or less non-cash type charge. Others say it's a real expense. It needs to be included. Just keep that in mind, right? If you were to exclude this, it would be even more in line with a mature company like Apple. So the idea here is that EBITDA growth is the real key to understanding the valuations of these capital-intensive hyper-growth stocks. And specifically looking at that relative to the total firm value as calculated by enterprise value is the way to go. So when you take a look at the enterprise value to EBITDA F12M of Tesla relative to Ford and GM, you'll see that those two were nearly equal. And I'm saying nearly equal. They're close at the end of March 2020, and certainly nowhere close now. But the idea here is that the buy side is betting that Tesla EBITDA growth is going to deliver actual EBITDA results, and that happening relative to its current enterprise value, that this ratio will actually start trending back down to what we call a normal type range. And what I want to show everyone what these normalized bands look like across a group of hyper growth stocks. You could look at this relative to the current tilt stocks that we use for the earnings certain portfolio. I mean, take a look at Adobe here, and you can see that its range of EBITDA growth is somewhere between 22 and 30, and you can see Amazon, Apple, Microsoft, Facebook, and Google. I mean, these are all really fairy tale growth stories, and you can see how they trend, and you can see what's happened to Tesla since. And again, if we go back to that time frame, back here at the end of Q1 2020, you'll see that they were all clustered together, and then Tesla just had this enormous breakout. Adobe broke out a little bit as well, but nothing like Tesla. Okay. So when we take a look at actual growth of EBITDA, and this is where we get to the real root of the issue here. In terms of a 1-year percentage change, right? Tesla is actually outpacing Apple by 6x, and it's expected to do this for the foreseeable future for primarily 2 reasons, right? We've got the electric vehicle market, I call it the TAM, which is the total addressable market, is just enormous. And Tesla has a lot of unlocked software revenues yet to be booked relative to a lot of the subscription services that you can purchase directly from the vehicles themselves. So autonomous driving probably being one of the larger ticket items. And you can see this tremendous growth in EBITDA starting right at those March lows and just absolutely going parabolic to the point now where it's 6 times Apple. And this is what's really gotten everybody excited. Okay. And when you take a look at this relative to a Ford and a GM, and keep in mind that GM is in the very, very early stages of their EV program, and I don't think Ford has given us much direction at all. And their EBITDA margins reflect that, right? There's just absolutely no EBITDA growth at all. You're getting literally 0 growth in EBITDA for GM and Ford, and you're getting 125% EBITDA F12M growth for Tesla. Okay, so just not even comparable apples and oranges. When we take a look at this same number for the tilt stocks relative to Tesla, you can see that ultimately these hyper growth companies, they will normalize out to a range, and you can see that. You've got Google anywhere from 12, Amazon all the way up to 40, and you've got Tesla at 125. So Tesla's still a hyper growth company, but keep in mind that I have a red line drawn here again back in March. All of these EBITDA growth rates on an F12M basis were roughly the same, and then again Tesla just broke out along with the price, and we all saw that. So the idea is we want to take Tesla now into the Zacks valuation model and actually look at what the buy side bid to current valuation is for this company. And what I did is I ran it through the valuation model very quickly and calculated the market implied growth rate. And if you look at the consensus forecast for EPS growth, you've got almost 200%, 175%, and down in 2022 coming down to 62%. So we do see some normalization of the EPS growth. But when we run it through the valuation model, we can actually calculate the long-term market implied growth rate. So this is the sustainable, supportable growth rate that the current buy-side bid to valuation is basically put the hurdle rate at about 30.83%. And this is based on annualized EPS growth long term. So the idea is if we believe that Tesla can continue this rate of growth normalized at 30.83% long term, then perhaps Tesla is not very expensive. And so when we take this into the growth and margin check, and we actually look at what's going on under the hood with Tesla, you can see that from a sustainability and a supportability perspective, right? Sustainable from the perspective of we've got revenue growth accelerating from 15% all the way to 50% in the forecast 4 quarters forward. At the same time, we've got net margins accelerating from that 1.97 number. Remember, depreciation and amortization range anywhere from like 10 to 15%, and we've got net margins of only 1.97, but those are accelerating all the way up to 7.1%. Okay, so this hurdle rate of 30.83% annualized growth is easily sustainable for quite some time. Should this trend continue, and that's the real story here with Tesla, and that's why the stock has just gone parabolic. Keep in mind too, you got to watch out for capital structure changes. and how your growth rates are actually being reported. Whenever I see major changes in capital structure here in terms of shares outstanding, I always like to look at the aggregate growth numbers instead of the diluted growth numbers. So in this case, it actually helps us out. It's a 50% growth rate versus a 40% growth rate. Okay. So the wrap up here for Tesla's addition to the S&P 500 is that the current buy side bid valuation is roughly 31%, and this is long-term growth in EPS. We know that revenue growth is accelerating to 50% in aggregate. Again, we look at the aggregate numbers, not the diluted numbers, because of the capital structure changes. And the net margins are expanding from 1.97 to 7.1 in the forward 4 quarters. The buy side is betting that long-term revenue and earnings growth is going to normalize to that 30% range. And that appears to be reasonable, just given the current growth trajectory of EBITDA, as well as the TAM for electric vehicles and all the other initiatives that Tesla has underway. So my opinion is, again, Tesla is definitely not overvalued even after its meteoric rise in 2020. So I don't think we should be fearing the addition of Tesla to the S&P 500. There is going to be volatility, but is this really anything new for us? Everyone that knows me knows I'm not a fan of passive index investing, but the addition of Tesla to the S&P 500 is definitely not going to hurt this group long term. So again, short-term profit taking in Tesla after the addition of the S&P 500, absolutely. We'll probably see some of that, but it's not to be feared. I think that there's a lot of value still left in Tesla. So be sure to tune in next week. We're going to start our growth series of webinars next week, and we're going to look for perhaps the next Tesla in pursuit of hypergrowth. And I'll be unveiling the latest addition to my personal portfolio that has a 1-year change in EBITDA growth of 767% versus obviously Tesla's at 125. So we'll explore all the similarities and differences between this stock and Tesla, and we'll do that next week. Feel free to reach out to me, link in with me on Twitter, LinkedIn. Anybody that wants a copy of the slide deck can go ahead and just send an email to zrs at zacks.com. You can send an email to your sales rep or your account manager. Thank you for attending, and we'll catch up next week.